Welcome back to FLB YouTube channel, this time also with the introduction to internal audit number 16, assets. So when you are in this worksheet here, first of all you have a description, okay, what it is an asset actually. So most likely it is not applicable in your entity, but if it is, check out if you have something like that. It means, so the definition is it a resource with economic value that an individual, corporation or country, so you as an entity, AIESEC entity, owns or controls with the expectation that it will provide future benefit. So if you have something very big in your office, for example, like a machine which costs a lot of money, and you expect that it will provide future value, that means it is an asset for you and you cannot simply treat it as an expenditure, but it is an asset which will be in your entity for longer terms. Okay, the audit goals are several, so just take a look into that. Into the self-assessment, this is very important for you to know if it is not applicable or not. So first of all, do you have some kind of investments which are above this border that you don't have simple expenditure? So there will be a local regulation, I'm sure, but it will be approximately 1,000 euros. But nevertheless, take a look into your local GAAP, so the generally accepted accounting principles, or simply take a look into IAS 38, so the international standards, accounting standards. In general, if you have no double entry bookkeeping system, then it simply doesn't exist. This is simply technically spoken the case. If you have it, which is recommended, take a look into this border. Good. Number two, which kind of depreciation do you use? So if you have something like that, so an asset which you're using for the next 3 years, for example, you need to depreciate it. That means at first you're booking it as an asset, so no expense, but as soon as you start using it, you have expenses, and these expenses need to be booked either linear or with another kind of depreciation mode. Check it out what you can actually do, but recommended is absolutely linear. If you have a linear depreciation, then it's just okay, you're using it for 3 years, and yeah, you divide it by 3, your asset value, and then you are booking it as an expense each year. The risk of error is quite low because it's quite simple to calculate. Number 3, next to machines, so material assets, you can also have immaterial assets like software licenses, etc. If you have that, which is not a subscription, this is important because mostly software licenses are today software subscriptions. In former days, maybe you still have a software license, this needs to be depreciated, or maybe it is already at 0, so it's not really standing in your books anymore. Good. If you have it, you go through the checklist. So first of all, you check what kind of assets you have and if they were capitalized and not simply booked as an expenditure. So that means when you take a look here, this is the correct booking. So asset to bank, so you pay for the asset and you book it as an asset. It is not an expenditure, so normally this is the booking when you're simply buying some small stuff or food, but this is the wrong booking when you have it as an asset which you are going to use for several years. Good. Recalculate the booked depreciation for each asset. Check if it's correctly. So if you have a lot of assets in your entities, so just make an Excel file and calculate if the booked numbers are correct or not. Number 3, if you find additional costs for an asset, so for example you bought a machine, but then you bought a second machine, an additional machine, to make the value of the machine even more, then it's an additional cost which needs to be capitalized because it is directly attributable to the asset. If it's not directly attributable, then it is most likely expenditure or another asset. Number 4, were newly capitalized assets in the fiscal year depreciated on a monthly basis. So if you bought something in November, for example, then you have to depreciate it for November and December at the end of the year, but not for the entire year. So you take 2 divided by 12 multiplied by the amount of asset you have. This is important. Nevertheless, take a look into your local GAAP if there is another regulation, but actually I don't think so. This is mostly the case. Number 5, were there any repairs which enhanced the duration of usage? So you have a machine and the machine was a bit damaged, but then you repaired it, and during the repairment you received something else, for example, actually I don't know, the duration was enhanced. So you could use the machine for 3 years, then you damaged it, you repaired it, and afterwards you can use it for another 5 years. Then you need to adapt the depreciation according to the new time frame. This will be most likely not the case in an AIESEC entity, just in case if you have something like that. Good. I mean, we are an exchange organization and we have no machines, normally spoken. Okay, in the end, write your report and go to the next checklist. So see you next video. Bye bye.